Supreme Court hearing a case right now that has enormous tax implications called potentially the quadrillion-dollar tax. I've got those details and what it could mean for you. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Guys, this is a big deal. It's a big deal. Supreme Court right now is hearing oral arguments about a case that could absolutely change the tax landscape. And I'm not exaggerating this. And essentially, it's rooted in unrealized capital gains and how our taxation works of property or investments and those things. And let me just give a baseline, and then we'll get into it and we'll talk about implications. Okay, so essentially, when you own an investment, let's say you bought a stock inside of just an individual investment account, not an IRA, not a 401k. Say you buy Apple stock here. And when you bought it here, if it paid any dividends or anything like that, you had to report that on your tax return, even if it was reinvested. But if you never sell it, the share price, you bought it right here, has gone up here and it's gone down, gone up, gone down. And say the share price is here today. Well, all of that appreciation, that's what's called unrealized capital gain, meaning you haven't sold it yet, so therefore, there's nothing, there's no official gain. Yes, if you look at your statement has grown in value from the time you purchased it, but there's no kind of realization of that gain unless you sold it. If you sell Apple stock up here, this unrealized appreciation now becomes realized, and that's when it lands on your tax return as a taxable gain, a realized capital gain that you have to report as income and so on. And the reason why they don't tax it until it's actually realized, at least here in the US, is, well, what if you wait long enough for Apple for the share price to go down and then down more and down more and down more, and then all of a sudden you actually get it right back to where you purchased it at, and you said, okay, well, now I'm going to sell it. I'm going to sell it now. And so even though it was worth this, well, you never sold it. You didn't sell it till it was right here, and now there's no gain to report and so on. So that's an oversimplified way of explaining capital gains, unrealized capital gains, and how the current U.S. tax code is set up to function. In that example, Apple stock, but same thing can be thought of with your house or with a rental property or with a business that you started, right? It's easy when you're talking about one simple case, but when you expand it to different use cases, it can get a little bit trickier. Well, let's contrast this with some other countries, okay? Some countries, yes, tax your income, which is what we do here, but other countries could, and some do, have what's called a wealth tax. So they actually look at your overall net worth, and there's certain, a definition, there's certain kind of rules you follow, and you actually pay a little tax on the overall value of your net worth, whether it's realized or not. So in that scenario, your Apple stock that you bought here, went to here. Every year at the end of the calendar year or whatever the set date was, you actually have to show or provide a tax return showing these are my assets. And yes, the value of that Apple stock went up. I never sold it, but the overall value is higher now, and therefore you are assessed a little bit of a tax. So that's called a wealth tax. Congress and so on has kicked this around, or at least I wouldn't say really flirted with the idea, but it's been kicked around before. Currently, we do not have that system. In fact, the only thing close to it is the inheritance tax or the estate tax. It's better known as the federal estate tax. And right now, you can have an estate up to, $13 million and still be exempt from paying a federal estate tax. If the laws sunset back down, we'll see that 13 million number come down to a very, $1 million, 3 million, 5 million is what's being kicked around right now, but we'll see. So the only thing close to a wealth tax that we have is the estate tax, and there's such a big exemption there that it really most people fly under the radar and are not subject to it. Okay, so that's all backdrop to level the playing field. Take a look at this case being heard by the Supreme Court right now. Just a rough overview here. Retired couple with a friend a friend from India invested $40,000 into this friend's company decades ago, long time ago. And it actually was with a noble cause. And of course, this is just from, the article. I don't know. There's, who knows all the details that are being omitted here. But for a good cause to help those in significantly impoverished areas in India. Well, this business did fantastic. Therefore, this couple put $40,000 in, or gave $40,000, invested $40,000 with a friend to start a business over in India. This business has done very well, has been very profitable, and now the Supreme Court is looking and saying, well, wait a second, should there be some tax on this, even though this couple has not sold the investment? They still own the investment. So in this case, the way I understand, it loosely, there's unrealized appreciation, just like there would be on your own family business that maybe you started, or maybe your folks started, whatever generation you're in, or maybe some farmland, or maybe a rental property or something like that. There's a lot of appreciation, but because it hasn't been sold yet, that appreciation hasn't been turned from unrealized to realized and become taxable. Well, there's a lot of nuances with this case, and because it's international, obviously that adds even more texture to it. But essentially, the financial world is looking at how the Supreme Court is going to rule here, as that could essentially open the door, not absolutely mandate it or require it or essentially put it in place immediately. It would still take an act of Congress and president and so on to put this in place, but it would open the door to the possibility of a wealth tax out there in the future, potentially, as Harvard professor has said, making this a quadrillion-dollar tax issue. So what does this mean? Should you be fearful of all of a sudden having to pay tax on a whole bunch of unrealized capital gains, or a whole bunch of property that you haven't sold, or so on, all of a sudden have to pay the tax on this? And I would say that would be premature, is starting to worry about that. But I would tell you, once again, the importance of having a tax shelter strategy is paramount in your financial situation. And hopefully you've got a fantastic tax shelter strategy. You're utilizing your 401k, Roth IRAs, those sorts of things to the full potential. And if you have investments above and beyond that, then this is something to be aware of. Know that even if the Supreme Court rules where now there is some tax that this couple is obligated to pay, even though they haven't sold the investment yet, it will still take an aggressive, I've seen that in some of the text, an aggressive Congress and president to sign this into law. Doesn't mean it would immediately take place, but something to be aware of. For the rest of us, work that tax shelter strategy. That tax shelter strategy may be even more important moving forward should this tax law ever change. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.